Good evening, everyone. Welcome to the channel. Today I am going to talk about Healthyway Inc. interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. And Healthyway Inc. offers a diverse range of businesses and services, including corporate and digital marketing, health and medical services, wellness content services, online general wellness content, real-time health answers, health-related articles, question and answer, or video clips through external physicians, real-world study support services for pharmaceutical companies, technology infrastructure, and / or marketing consulting services, digital marketing services, healthcare services, plus appointment scheduling, plus medical agency, plus medical escorting, plus physical examination, plus medical consultation, plus surgery appointment and scheduling, other medical support services, patient guidance, patient satisfaction surveys, healthcare service packages, nutritional supplements, transdermal patch, health membership schemes, operation of Yahoo.com health and medical platform, sales of medicines and medical devices. The stock price decline of Healthyway Inc. Healthyway Inc.'s stock price has experienced a significant drop in the past year due to several factors contributing to decreased revenue and gross profit. The company forecasted a 15-18% decrease in revenue and an 8-12% decline in gross profit for the first half of 2025, despite expecting a return to overall profitability. Key business segments have been affected by reduced content service revenue, decreased value healthcare service revenue, and lower digital marketing service revenue. These declines were attributed to increased competition, budget cuts, economic downturns, and expiring sales agency agreements. Furthermore, a significant shareholder, Chen Yang, reduced his stake in the company by 3 million shares, which can signal a lack of confidence in Healthyway Inc.'s future prospects. This combination of factors has likely contributed to investor concerns and downward pressure on the stock price, resulting in a substantial decline from its 52-week high of HKD 62.7 to recent trading prices around HKD 8.85 to HKD 9.62. The primary drivers of revenue growth or decline can be attributed to a few key factors. On the growth side, an increase in registered individual users on the platform and expansion of precision content services to more pharmaceutical companies contributed significantly to revenue growth. Additionally, an increase in RWS support services provided to these entities also boosted revenue. On the other hand, revenue decline was driven by a decrease in corporate and institutional customers, challenges in the pharmaceutical sales business, and a reduction in health membership schemes and online medical consultations arranged on the platform. These factors collectively contributed to the decline in revenue. Net income and profit margins. A shift in trends. The financial summary reveals a mixed bag of results for net income and profit margins. Initially on page 10, the company's net income decreased by 11.6% from RMB 183.7 million to RMB 161.7 million. However, this trend reversed on page 28, where net income increased significantly from 57,275 to 7040. Profit margins also underwent changes. The gross profit margin fluctuated across different pages. It decreased from 30% to 31.2% on page 10, but dropped more substantially to 4.6% on page 28. On the other hand, operating and net profit margins showed improvement, increasing from 0.4% to 1.8% and -9.3% to 1%, respectively. The reasons behind these changes are multifaceted. Business mix, pricing policies, and cost structures affected gross profit margins on page 10. Conversely, the increase in government grants, decrease in net foreign exchange loss, and rise in interest income contributed to improved profit margins on page 41. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. In 2025, the net cash generated from operating activities increased by 165% compared to the previous year, reaching RMB 34,670. This substantial increase suggests that the company is successfully managing its business and generating positive operating cash flow, which is a crucial indicator of financial health. The company's debt level and interest expenses have undergone significant changes in recent years. In terms of debt level, the data shows a decrease in loans and borrowings across various pages. On page 13, the amount decreased from RMB 55.5 million to RMB 54.4 million, while on page 14, it dropped from RMB 56.4 million to RMB 54.7 million. Furthermore, non-current liabilities, loans and borrowings, saw a substantial decrease from RMB 905,000 to RMB 13,301,000 on page 31. Regarding interest expenses, the company has experienced a notable reduction. Finance costs decreased by 39.1% from RMB 12.3 million to RMB 0.4 million on page 11. Additionally, interest expenses dropped by 1,161 RMB 0, from minus 2,156 RMB 0 to minus 995 RMB 0 on page 34. Overall, the data suggests that the company has successfully reduced its debt level and interest expenses in recent years. The financial performance of the company varied across different segments and regions. In terms of segments, corporate and digital services, as well as health and medical services, experienced a decline in both revenue and gross profit from 2024 to 2025. Specifically, corporate and digital services saw a decrease in revenue from RMB 488,539 to RMB 413,059, while health and medical services revenue dropped from RMB 122,829 to RMB 104,638. However, the company's performance was not uniform across all regions. China, being the primary source of revenue for the group, performed well, with substantially all of its revenue arising from this region. Management is projecting an improvement in the company's financial performance and profitability through various revenue streams. They plan to utilize net proceeds from these efforts for strategic investments, research and development, and working capital by December 2027. Despite cautious optimism about the business outlook due to challenging market conditions, there are no plans for significant investments or capital asset additions. The company has chosen not to distribute any profits to its shareholders through dividend payments. Instead, it appears that all available funds have been retained within the business for future growth and development. That concludes the financial summary for Healthyway Inc. Feel free to comment below, and I will be happy to answer them when possible.